My name is Sohaib. I'm going to do a small presentation explaining why should you invest. That is the big question. In order to answer that, let's see what happens when you don't invest. I'm going to explain shortly what that burger is doing in this presentation. Let's imagine you are in year 2000 and you have $100. I'm going to use McDonald's Big Mac as a standard guide in this example. Why Big Mac? It's easy for me to explain using that example, and there is actually a Big Mac index. It is regarded as an indicator for the purchasing power of an economy. I call this the Big Mac theory. On the left side, you can see in year 2000 April, the price of one Big Mac in the United States was $2.51. How many Big Macs were you able to buy with $100? You can see using simple mathematical formula, you were able to purchase 40 Big Macs and 40 days lunch with $100. Imagine someone told you to invest, but you were reluctant and you opted to keep that $100 in your bank account, simple bank account with no interest in it. Let's see how many Big Macs were you able to buy in a year 2020 with same $100. Data shows that the price of the single Big Mac in the United States in year 2020 was $5.67. Let's apply that to our simple mathematical formula of division. With $100, one burger worth 5.67 in year 2020, you were only able to purchase 18 Big Macs as compared to 40 Big Macs in year 2020, means less than 50%. Now imagine someone told you to invest in a year 2000 that $100, but you are reluctant to invest and you opted to keep that $100 in your bank account, but this time you decided to keep it in a saving account that was paying 1% to 1.5% interest rate per annum. Let's say your bank was good and you are very lucky and was happy to give you 1.5% interest rate per annum. This sounds good for 1.5% per year. Let's apply this to Big Mac theory. Now with 1.5% interest rate after 20 years, your $100 in year 2020 would have been $135. Apply this to Big Mac in year 2020 and it shows that you were able to purchase 24 Big Macs, means 24 lunches. Still less than 40 lunches in year 2000. Now here it explains no investment, 18 Big Macs, saving account of your bank, 24 Big Macs, but it's still less than 40 Big Macs which you were able to purchase with same $100 in year 2000. Means your money lost 40 to 50% of its value by sitting in your bank account. Why this happened? Reason is one word: inflation. Inflation is approximately 2% rise of the goods that we use in our daily life, generally speaking. Clothes, wheat, bread, milk, food, dairy products, everything that we use, their price goes up as time progresses, and generally they say that it's 2% rise per year. Now, how to beat the inflation? Because keeping your money in your bank account is not sufficient. The simple answer is, if you have to beat inflation, you have to invest. There are three things that beat inflation on a long-term horizon. By long-term, I mean 10 years, 15 years, 20 years. Less than 10 years, that doesn't mean long-term. So the keyword here is long-term. Those three things are real estate, bonds, and stock market. What is real estate? I'll briefly touch. You buy property and you rent it out and get your monthly rent, or you live yourself. You need capital for that and need professional support and advice to do so. Alternate is REIT, which is professionally or personally managed real estate portfolio. Very difficult to do so on your own. I'm not going to discuss real estate or REIT here. It is beyond the scope of this beginner level presentation. Bonds. Again, you can find about what are bonds, different types: government, corporate bonds, 2-year bonds, 5 years, 10 years, 20 years. Generally speaking, you buy bonds. Let's say you buy 20-year fixed rate bond, and that means you buy and then you cannot sell for next 20 years, but you are guaranteed to get a better interest rate on yearly basis for next 20 years. Key point is their is better interest rate. For example, at the moment, 20 years UK government bond interest rate, fixed interest rate is 3.37%. Let's say you bought 20 years government bond, UK government bond in year 2000 with 3.37% annual interest rate. Your $100 after 20 years from year 2000 to 2020 would be worth $196. Let's apply this to Big Mac theory. With 3.37%, you're now having $196 and you are able to buy 35 Big Macs, better than 18 and 24 without investing. But still, you are not able to buy 40 Big Macs even after investing in bonds. Reason is because you're not getting sufficient return. Bonds are safest. They have got fixed interest rate, better than keeping money in the bank, but they are still not sufficient because they have low returns. Now, let's have a look at the stocks. Stocks represent the piece of ownership in a company. I'm going to give an example of an Apple. Apple has 25 billion shares, let's say, roughly speaking. It means that the Apple company has been broken down into 25 billion pieces. When you buy one share or 10 shares, means you own one piece of Apple company. Out of those 25 billion pieces, you are owner of an Apple company, although one share. Now, as Apple company or business progress, it becomes profitable, it makes money, your share price will go up and will be worth more. But if Apple company start losing money, your share price will be worthless. This means if it is going up, you're making profit. If it is going down, you're in a loss. That makes stock more risky. But stock market as a whole, I'm going to explain what I mean by stock market. Stock market as a whole gives better long-term return, not individual stocks, stock market, approximately 7% to 7.5% annual return. Now, I'm not going to discuss individual stock as I mentioned. I'll discuss about stock market as a whole, which in my opinion and which in reality is S&P 500. S&P 500 is made up of 500 large companies listed on exchanges in the United States, and this S&P 500 index fund actually tracks the performance of those 500 large companies. It includes Apple, Google, Facebook, Tesla, Bank of America, Costco, Walmart, ExxonMobil, and many more, McDonald's, Procter and Gamble. You can easily Google the 500 companies of S&P. Now, this is the safest place to invest, as list of those 500 companies keep changing. If you don't perform well, you will be removed. So essentially, S&P 500 is always made up of 500 best companies in the world. Now, in year 2000, if you look the companies that were in S&P 500 and you compare it with the 500 companies that are in S&P 500 now, you will see the difference if you study in detail. Any company that is not performing well is shown the exit door. Any company that is performing well is included in S&P 500. Now, let's check the S&P 500 annual return in last 20 years from 2000 to 2020. This is the data available on the Google. I have gathered the data from 17 March 2000 to 11 December 2020, and you can see on the left side the index rose by 150%. So there was a dot-com bubble, there was a market crash in 2000, there was another financial crash in year 2008, there was COVID crash, there have been different wars, but still S&P 500 went up by 150% in those 20 years. Now, in 20 years, 150% increase, that means 7.5% annual return on yearly basis. Inflation adjusted 6.9%, let's call it a day, 7% annual return. So if you had invested $100 in S&P 500 in the year 2000 and did nothing afterwards, nothing, bought S&P 500 for $100 and left it, it would have been worth $386 in the year 2020. Apply this to Big Mac theory, you can see that you were able to purchase 68 Big Macs, means $100 in year 2000 was able to help you buy 40 days lunch. And if you had invested in S&P 500, same $100 would have been worth $386, and it was sufficient to buy 68 days lunch. This means that your purchasing power increased. You in the year 2020 was able to buy more Big Macs, although which were expensive, but you were still able to buy more as compared to year 2000. I hope this explains why we need to invest and why keeping money in the bank account is not a good idea. Now the questions are how to invest, what platforms to select, and when to invest. I'll leave this for another day. Before that, please search on a YouTube Warren Buffett S&P 500 video. I'll also share the link in this post also. It's really important to listen from those who are successful investors rather than me. Happy to answer any questions you can leave in the comment section.